Hi everyone, it's Lawrence here, just doing a quick sound test to see that everybody can hear me. So just type in yes if you can in the chat bar so that I know you can hear me. We'll be starting in a minute or two, just getting the last of the latecomers come through. Hello everyone, just doing another sound test. Please let me know if you can hear me. There we go. Seeing a lot of yeses, brilliant. Thanks guys for joining us again tonight. It's going to be an eventful, informative evening as always, talking about how to do capital deals without much of your own money. Let's just give some of our latecomers just 1 or 2 more minutes and then we'll get started. Thanks so much for joining us. In the meantime, if you'd like, you can also pop in some questions for what your expectations might be or what you're hoping to cover as we wait for our last few attendees to come through. And then obviously through the evening, we will answer those questions as best we can. And we've also got a poll going tonight. Essentially, we're going to show you 3 different ways in which you can finance a deal, either through creative finance, institutional, or private. So just go into the polls tab, go and select the one that you'd like to, use in the future, so that we can focus a bit more time on that. Awesome. I'm seeing Cornelius, Tabisa, Andrew, Sherwin, Marcel, Samuel, Eric, Paul. Welcome everyone. Evolt, Gerald, Mohammed, Pakiso, Alex, Chester, Sean, Theo. Well, awesome. We've actually just reached over 100 people in the webinar tonight, so that's awesome. Zodwa, Keanu, Winston, Gerard, Simone, Shafiq. Awesome, guys. Thanks so much for joining us once again. It's going to be an informative evening. I'm going to give the last few of the attendees another 30 seconds, and then we'll get started. Okay, I've just put on the video. So you should see a slide that says raising capital with little to none of your own money. If you can't see it, please just post in the chat bar, and I'm going to ask Dave to just respond to you privately. Okay. So a couple more seconds. Again, please go and check out that poll and answer whether you'd like to know more about creative financing, institutional, or private financing. We will discuss all 3 deals or strategies this evening, but it will be a good sense for us just to know which one is your biggest interest. Fantastic. Ladies and gentlemen, we are going to get started. As always, we will record this session and it will be available either on the My Property app tutorial page or alternatively it'll be available on Sapin's member portal. I'm going to ask Dave just to put links to those potentially in the offers page. So if you look on the right hand side of your screen, you'll see a chat bar, you'll see polls, and then you'll also see offers. There you will find links to the My Property app as well as Sapin's members portal so that you can access this tutorial at a later stage. So raising capital with little to none of your own money. What I am also going to ask you to do is just to post your questions on the platform, and then I'm going to also ask Dave just to collate those so that at the end of the presentation we can unpack each one of those questions, hoping to get you guys out in 45 minutes. So let's get started. First of all, the 2 hosts or the 2 speakers for the event is obviously myself, Lawrence Boel, as well as Dave McGlashan. I'm the good-looking guy on the left-hand side, and then Dave is the less good-looking guy on the right-hand side. So yeah, thanks for joining us today again, guys. I'm going to do most of the talking this evening, but Dave will step in when there's certain questions or if he feels that I've missed something. As you guys know, we are property investors, coaches, and entrepreneurs, and spend most of our time investing not only in property but finding the capital to do those deals. Now, the first principle to raising capital is to find a great deal. Now, I've had a lot of students that come to me and they say, Lawrence, we don't know where we're going to find the money, but they don't even have a deal on the table yet. So my first principle, and I think Dave would agree with me on this one, is that when you find a good deal, the money will flow. Focus on finding the deal, securing the deal, and then looking for the financing. So the first principle, and I know it seems rather basic, is to first find a great deal, then put together an investment proposal, then try and approach somebody for capital. Now, there are some tutorial videos on how you can analyze deals, how you can find these investments under the My Property app video tutorials page. So things like, strategy area property, how to analyze a student deal in 30 minutes or less, how to analyze a buy to let, buy to flip, how to analyze an area. All of those sort of questions are answered with tutorial videos on the app. So go check it out. This specific webinar is all about how to raise capital, not how to analyze a deal. But remember, principle one, first find a deal, get a great deal on the table, then try and access the financing. Cool. Now, there are three major financing avenues that I want us to discuss this evening. First one being private financing. Second being institutional, or let's call it public financing. And the final one being creative or potentially advanced financing. So we're going to unpack each one of these avenues in a little bit more detail. And I thought to really, to make it real for you is to use a real case study or a live example of how I've used one of these financing techniques to do a deal. So let's jump right into private financing. The first and probably the most common source of private financing is through an angel investor. Now, an angel investor is essentially somebody who is capital rich but time poor, somebody who's got maybe 500,000, maybe R1 million in the bank that wants to invest and get a better return than they're getting in the bank, but they don't have the time and potentially the experience to go and find a property opportunity. Now, these are the kind of people that you can find at networking events, through friends, through family, essentially talking to people and explaining to them that you are an investor who's finding property deals on a regular basis. Once you find an angel investor, it's great that, once you've done a good deal with them, that you'll probably be able to lend money from them in the future for the next deal. Finding the investor can be hard, but once you've nurtured that relationship, you've done a successful deal, they can be a great source of finance. Friends and family is also under the category of private financing. Now, of course, some of us are not privileged to have wealthy friends or families. If you don't have a wealthy family, I mean, that's not your fault. You didn't choose the family that you were around. But if you have poor friends, then maybe it's time to consider upgrading your friends. I mean, of course, you want to keep the friends that you have from school, but you also want to be surrounding yourself with high net worth individuals, because you become like the friends you surround yourself with. So if you're tired of being broke, it might be because you're in environments that are surrounded by people who are broke. And this is where the initiative of the SAPA network, the South African Property Investors Network, comes in handy, because these are monthly networking events where you get to learn from, get educated, and network with some of the best and brightest minds in property in South Africa. So if you want to know more about SAPA's networking events, just go check the office page. I'll ask Dave to put something there for you. Colleagues and acquaintances. Now, I heard a story of a newcomer to the investment world. He found this great opportunity, put together an investment proposal, sent it out to about 30, 40 people, and no one came back. Not even a niggle. No one even interested in finding out more. And then he gave the investment document to his secretary and said, please, can you just check through this document and make sure there's not a spelling mistake? Because he felt like there was something wrong with the document. That's why he wasn't getting a response. And the next morning, the secretary came to him and said, you know what, I've actually got 300,000 Rand in the bank that I've been looking to invest. I just didn't know where to put it. Can I invest in your deal with you? Now, this is an exact example of you need to be talking to 30, 40, 50 people about your deal. You're mostly going to get no's, but there are people in your network that you don't even know that have capital, and you can tap into and access that. So definitely colleagues and acquaintances, networking events. One of my students, Nate, I think some of you guys might know him. He's a very successful investor. He's done over, I think it's about 8 deals now, using majority only other people's money. And he found all of them through networking events, through talking to people. And sometimes you'll go to a networking event and you will meet no one. You might meet everybody who's got deals, but no one who's got money. But then you'll go to a networking event 2 months later and you'll find people with lots of money, but no deals. That's why regular, consistent attendance of these networking events is crucial. It's not just going to one event, hoping you find everybody you need in your power team. It's a journey, really. Stockfell or crowdfunding, essentially what this concept is you've got multiple people that come into the deal with you. So instead of trying to find one person with R1 million, you find 10 people with R100,000 each, or 100 people with R10,000 each. And thus you create almost an investment club or an investment community, and you invest all the money that's put into this club into property where each person shares the returns. So it's a very common concept in South Africa, especially the Stokvel version. So good way to also think creatively about a deal. The last idea that I have for you tonight regarding private financing is joint venture partnerships. Now, a joint venture partnership is essentially coming together and partnering with someone who might have something that you don't have. So I might have, let's say, a deal and I have a good builder, but another person might have the capital and has a good attorney. That is where a mutually beneficial partnership comes in. We get into an agreement where we share the resources we have in order to do a successful deal. Now, in order to show you how a financing strategy in the private sector could work, I thought I'd use an example. So I recently did a deal with a joint venture partnership, and this is how it turned out. So the property that you're seeing now on your screen is a block of flats in Rosettenville. It's called Centurion Place. And basically the detail of this property is that it's 4 3-bedroom flats, fully let currently, great tenants, very little voids. And really, principle one, this is a great deal. It's an absolutely phenomenal deal. The money should flow easily. Now, this is what the financials look like on the deal. So the agreed price that we've negotiated with the seller is 1.5 million. The rental coming in every month is 24,000. The monthly operating expenses, so basically the expenses of running this property on a monthly basis, is 10,500. So the profit, the monthly cash flow on this deal is 13,500 with a return of investment of just over 10%. As you can see, well, maybe you can't see it, but this is a cash deal. Now, I did not have access to 1.5 million, but I had about half of that in available funds. So what I did is I put together an investor proposal. If you do use the My Property app, with a click of a button, it will automatically generate an investor proposal, basically detailing the numbers, what the areas of risk and reward are. It'll also do a 10 or 20-year projection of how the deal will do over a period of time. So I put together a really nice, slick, professional investor proposal, and I spoke to, must have been about 12 or 15 people around this deal, including family, friends, and then, of course, acquaintances. And that's when this friend of mine came up and said he would like to invest with me. On the right-hand side, that's Clinton and his wife, Tina, and their little child, Ethan. And they are quite new to the property game, and they wanted to get themselves into a rental deal. So the agreement is that we've got a 50-50 split of purchase price and buying costs. So the agreed price of 1.5 million, we're going to go in 50-50. I'll bring 750, he'll bring 750. And then all profits and losses of the company will also be split. So if we do really well this year and we make 100,000 Rand profit in rentals, then we'll split that 50-50. Alternatively, if we make 100,000 Rand in loss, I will pump 50,000 into the business. He will pump 50,000 into the business. So what's great about having this partnership is that, of course, my risk has been halved, as well as my reward. But because my risk is halved, I'm happy to take half the reward because, of course, my risk is lower. We bought this in a newly registered company where both of us are directors, and we shared the shareholding 50-50. So everything is very equal, very fair. There's a 50,000 Rand sourcing fee applicable, which will be paid by Clinton because I did a lot of the work regarding the negotiation. So I feel that my time has been, the payment of my portion of the sourcing fee. And the coolest thing is I met him at a Toastmasters event. If you don't know what Toastmasters is, it's a club for people who enjoy public speaking, and it's something that, it's a group and a community that I attend at least once a week. And I think it was about a year and a half ago that we met at this event. He heard me speak. He came up to me and asked me for some speaking lessons or speaking advice or whatever it was. We met for coffee a couple of times. Then he learned that I was into property and I showed him some of the deals that I've been doing. And over the last year and a half, we've nurtured this relationship. We've built, I would say, a friendship more than anything. And we've got trust now going to the point where we're willing to do business together. That is the example of private financing. It does take a while to meet these people, and then it takes even longer to build a relationship to the point where there's enough trust for you to do a deal together. But it's definitely worth the investment. So, this is an example of a deal done in a joint venture partnership agreement. Let's look at some institutional financing. Institutional financing really just means using more the concept of like the traditional financing approaches that you might be used to. So things like bank financing, getting ABSA, Standard Bank, FNB, whatever it may be, to finance your deal. So they would provide you with a loan to value of, let's say, 70%, 80%, 90% of the property. You would have to come up with a deposit. They would charge you an interest rate of 10% on a monthly basis, and thus you pay your loan off. Credit card, a lot of us, or a lot of South Africans maybe have a negative association to credit cards, but I think it's because, unfortunately, many people use credit cards for luxury and lifestyle instead of using it for assets. So a credit card would be a useful tool to use if you need to pay for like a renovation, a small renovation of 50,000 Rand, or let's say the transfer fees or transfer costs of a deal. Credit card could be a great way to fund that in the interim while you're waiting for the property transfer to go through, whatever it may be. So credit card, as long as you're using it for assets and for things that can pay it back, you should see a credit card as an investment card. If you're using it to pay for holidays and for luxury and lifestyle, then yes, it's a credit card and it should be avoided. Overdraft is also another, let's call it institutional creative financing technique. Essentially, overdraft means that you basically go into credit in your bank account. So it's similar to a credit card, except it's based on your debit card. Depending on your risk profile and how you use your bank account, the banks might offer you an overdraft facility. Equity release. Equity release, I'm gonna show you an example now of a deal done through equity release, but a very, very, very powerful strategy. So I'll talk about that just now. TUHF, also known as TUF. This is a commercial bank that is willing to lend on commercial properties. Now, when you're looking for a commercial loan, you tend to get worse terms than you would with a bank loan. Traditionally speaking, if you get a loan from ABSA, you'd probably get a 90% loan to value at a 10% interest rate or prime interest rate. With a company like TUF or a commercial lending house, you would receive maybe 70% or 65% loan to value over 15 years at a 12% interest rate. So because you're working with higher risk deals, these companies are also going to charge a higher interest rate because they have to protect themselves. They have to, make the return worth the risk that they're taking. What's nice about these institutions and these, let's call them commercial funding houses, is that they will fund more risky deals. So they will fund student accommodation, they'll fund multi-lets, they'll fund blocks of flats, those kind of things where traditionally banks might be a bit more hesitant. These commercial bankers be a little bit more open to it. Bridge financing. Bridge financing, similar to TUF, it's also more short-term lending, so maybe 5 to 10 years, higher interest rate, lower loan to value. Remember, when there's more risk, there needs to be a higher return for the lender. So bridge financing is an example, again, of an institutional financing opportunity. Let's have a look at equity release. Equity release. Now, this is an example of where I used equity release to fund a deal. It's a student accommodation property in Brixton. As you can see, it's a 6-bedroom house, student accommodation. Now, the financials on this deal, essentially, the agreed price is 1.2. So from 1.4 to 1.2, a 200,000 Rand discount. The rental on this deal would be 26,400. The monthly operating expenses would be 21,400, meaning the profit on this deal would be around 5,000 Rand positive cash flow, a return on investment of 11.44%. So again, principle number one, find a great deal worth investing in, and then it will be easier to find the investors. So how this deal will be financed? Now you can't always get a home loan with a student accommodation or a multi-let because again the banks see it as a risk. But what you can do is you can get a traditional home loan on the property. So this six-bedroom house, if it was converted to a home, would be worth roughly 1 million. You can get a loan based on that basis. As long as you can convert the student accommodation back to a traditional normal house, you can get a home loan on that property. So I won't be able to get a home loan on the 1.2 valuation because that valuation is based on the rentals that are achievable for that property. But I can get a home loan of R1 million. Then I would use my credit card to fund 40,000 Rand worth of transfer fees and bond registration fees. And then there's a 200,000 Rand additional charge that I would need in order to cover the deposits and some of the other additional costs. Now that 200,000 Rand is going to be an equity release from my primary residence. So the house that I currently live in has over 200,000 Rand equity. I'm going to release that equity and reinvest it into this deal. Now, what does that mean? Equity release. So imagine you've bought a property and the value of that property is 1 million Rand. You go to a bank and you get a bond on that property worth 700,000 Rand. So it's worth 1 million, but you got a loan at 700,000. The remainder of that value is known as your equity. So your equity is your resale value minus your outstanding bond minus your selling costs. Essentially, it's the money you have left in the deal if you were to sell the property. So what you can do is you can go to the bank and say, hey, Mr. Absa or whatever, the property is actually worth 1 million. I've only got a 700,000 Rand loan. Assuming my affordability is sufficient, can I take that extra 300,000 Rand worth of value in my property and can I get a loan for that? Now, this equity release is applicable to any asset that you have. If you've got a car that's worth 100,000 Rand, you can go to the bank and say, I'd like to take a loan on this property, on this car, for 70,000 Rand. Essentially, what you're doing then is you're giving this collateral or this asset as collateral to the bank in exchange for a loan. So equity release is a very powerful way in which you can, take the money that's sitting in your house, sitting in your primary residence, that's not working very hard for you, and you can reinvest it into a property opportunity that makes more financial sense. So that's exactly what I did. I took 200,000 Rand out of my primary residence, or will do it. This deal is currently still in negotiations with the estate agent, but I do have that facility available. In South Africa, it's called the access bond. So make sure that if you do have a bond on your property, try and always get a flexi option or an access bond so that you can, as the equity grows, release some of that equity and reuse it for an investment. Next, we've got creative financing, and I want to put a caveat here that this is more your advanced techniques. We've looked at private, which is really within your social groups, within your network. Who can you tap into in order to raise the money? Institutional is your traditional banking finance. Creative or advanced strategies is a way in which you can use, I want to say, more of an advanced approach to accessing money. First one is seller financing, and this is a very, very popular strategy. Essentially, imagine you've got a property that's on the market for R1 million. It needs 200,000 Rand worth of renovations, but it can sell for 1.5 million Rand if you were able to renovate it. Now, instead of trying to find bank finance or an angel investor to buy the property for R1 million, you can go to the seller and say, why don't we go into a partnership? You continue owning the property. All I'm going to do is I'm going to come in and I'm going to fund 200,000 Rand. We're going to bring the value of the property up to 1.2 million. And then when we sell for 1.5, we'll split the profit equally, 50-50. This is a win for both parties. The seller gets a much better return than he would have if he sold it in its current poor condition. You, as the investor, you don't have to put R1 million down to buy the property. You only have to find 200,000 Rand in order to renovate the property, and you both get to share in the profits. The trick with this one, and what you do need to be very cautious of, is you need to have a solid contract in place between you and the seller. Because what you don't want to have happen is that, you invest 200,000 Rand into this deal, and 6 months later, when you're about to resell, the owner says, well, thanks for renovating my property, but I'm actually going to keep it, and you can go away. And if you don't have a contract in place and you've got nothing, holding you guys together or holding this deal in place, they can just walk away from it. So make sure that you're consulting a professional. Um, if you do need a lawyer in the space, our recommendation is Bruno Samao Attorneys. They do a lot of work for the Sapin Network, and they are very, very proficient in property law. So that's Bruno Samao Attorneys. Go check them out. Make sure that you invest in the right legal protection when doing seller financing. The next concept is known as the back-to-back. Now, a back-to-back it's a difficult strategy to implement because you need to find the right situation. You need to find a seller who is distressed and motivated to sell, and you also need to find a buyer who is eager to get involved. So essentially, what you want to do is you want to find a distressed seller, sign an offer to purchase with them. And that offer to purchase is a legal agreement securing the deal at a certain price. So let's say you find a property that's worth or that's that the owner is willing to sell for at 300,000 even though it's worth 500,000. So you sign an offer to purchase with this distressed seller at 300,000, and then you must give yourself a time frame in order to access the other capital. So maybe in the suspensive clause on the OTP you say that you need 2 months to find or raise the capital. Then you've got a 2-month period to go and find this hungry buyer who you can sign another offer to purchase with for 500,000 Rand. So essentially what's happening is you're signing 2 offer to purchases. You're securing the deal with the seller, and then you're securing the finance with the investor. What happens then is the investor's money is paid to the seller, the 300,000 to honor the agreement you've made with the seller. That 200,000 Rand profit would be yours for the taking. I mean, obviously you have to pay legal fees and transfer fees, so there will be a couple of fees associated. But if you can find the right opportunity with a distressed seller and a hungry buyer, you can essentially back to back the agreements and never actually own the property. Again, hard to find, hard to implement, but with the right attorney and the right deal, it is possible to do a deal with absolutely no money. You just have to find the right scenario. So back to back, and I think what would be actually quite useful, Dave has implemented this strategy successfully before, and maybe Dave, I don't know if you'd be open to doing a webinar on back to back.
Yeah, we could do a deep dive into one of my Z-Point deals. That'd be nice.
Yeah, I think that the concept of making money with none of your own money in the deal is very attractive. But like I said, it's a hard one to implement. So Dave, do you want to maybe add to the back-to-back strategy?
Yeah, look, I think at the end of the day, I think it's more tricky than it is hard. It takes a lot of education of sellers and buyers and often attorneys. And the big challenge that we have with back-to-backs is timing. It really is about knowing the process and knowing the buying process and being able to manage all those relationships and all the time in between, essentially 2 different purchases at the same time. I think it'd be a hard task to try and do a back-to-back if it was your first deal. You definitely have a difficult time there.
Yeah, and I think that's why the caveat on this is these are advanced finance strategies, so I wouldn't jump into these off the bat. But I just want to make you guys aware that it is possible to do deals with very little to none of your own money. So Dave, maybe, or not Dave, the audience, if you guys do want to hear from Dave regarding a back-to-back session where he can deep dive into the logistics of running a back-to-back and maybe showing you 1 or 2 examples, just pop that in the chat, and then I'm sure Dave would be more than happy to schedule some time and do a webinar for us. The next concept is known as rent-to-rent. Now this one, although it's an advanced strategy, is definitely something you guys can implement today. Think of the concept of essentially renting from the owner and then subletting to a group of people. So my favorite example is student accommodation. If you can find, let's call it a 5-bedroom house in Brixton, Vredendorp, Auckland Park, West Deans, which is areas within Johannesburg that are close to the University of Johannesburg. So you're looking at any kind of area that's between 1 and 1.5 kilometers away from the university. If you can find a 5-bedroom house and get a good rental price from that owner, you can make a lot of money off property without any of your own money involved. So if you find this 5-bedroom house, and let's say the owner wants 10,000 Rand rent, so you can rent the property from the owner for 10,000 Rand per month, and then sublet the 5 rooms to 5 students. Each student might be paying, let's say 4,000 Rand per month. So that's 4 times 5 means you're getting 20,000 Rand of rent in. You're paying 10,000 Rand rent to the owner. So the owner's happy. He's getting his monthly rental in. You're getting 20,000 Rand in, which means you're making a cash flow, of 10,000 Rand. And then you obviously have to deduct your expenses like maintenance and voids and all of that stuff. But essentially, all you need is you need a 10,000 Rand deposit to secure the rental and 1 month rent. And then once you sublet to the other tenants, they start paying that off for you. So rent to rent, the idea is very simple. You rent from an owner, then you sublet to various other tenants, making sure that the sublet fee is greater than the rental you are paying. Great way to get into the rental cash flow market without much money. Final creative strategy that I have for you guys tonight is known as a lease option, or in South Africa, it's more commonly known as the Alienation Land Act. Now, this concept is definitely more for the advanced investor, and not something that you want to start with, but a very, very powerful strategy. It is also quite a complicated strategy, so I'm going to try and explain it the best way I know how. But obviously, please pop your questions into the chat bar if something doesn't make sense. So let's have a look at the lease option concept, and I'll explain this using a deal as well. So first of all, a lease option, there are some key requirements. One, you need to find a distressed house with a distressed seller, and you need a very, very good attorney, an attorney that has done this before. There are very limited attorneys in South Africa that are successfully have achieved doing a back-to-back, doing a lease option or Alienation Land Act. Again, chat to Bruno Samau. He should have the experience to do it. So you find this distressed house with a distressed seller, right? Let's say in 2015, you agree a lease option with this distressed seller, right? The agreed value of the property in 2015 is 1 million Rand. The bond repayments on this property is 10,000 Rand. Now, it's a distressed house, so it's in physically poor condition. Also, the seller is distressed, so they don't necessarily have the money to renovate the property and bring it back to good standing. Plus, they still have to pay 10,000 Rand in bond repayments every single month. So you can see they're very motivated. They've got a dead asset, they're unable to renovate it, and they're losing money on a month-to-month basis. This is the perfect scenario for a lease option. What a lease option is essentially you are taking control of a property. You're not buying it, you're not owning it, you're taking control. So I would take control of this property, I would renovate the property, rent it out once it's renovated, and I would pay the bond on behalf of the seller. So the seller's concern is that they can't renovate and they still have to pay 10,000 per month. What I'm doing here is I'm saying, give me control of your property. I'll renovate it on my cost. I'll rent it out. I'll manage the tenants. I'll manage all the maintenance and the management every single month, and I'll pay your bond off. But I'm not going to buy the property. So you're solving their need, plus there's a little bit of cash flow. If the amount that you rent it out for is more than the bond, that is your cash flow. You don't actually have to buy the property. Now, what you do have to do is, of course, similar to the seller financing, is you have to put a restriction on the title deed. So you're going to come in and renovate this property. You don't want the owner then to take back the property and say, oh, thanks for renovating it for free for me. I'm now going to rent it out and this is my asset again. You have to put the right legal contracts in place, as well as a restriction on the title deed so that they cannot sell it without your consent. Now, a lease option, they last for different periods of time depending on the lease option that you want. Let's imagine that this lease option is going to last 10 years. Essentially, what that's saying is that for 10 years, I am allowed to control and own this property, or not own it, but control it. Now, in 2025, let's assume that the property's value is now 2 million Rand. The bond repayments are still 10,000. What a lease option allows you to do is it gives you the option to buy, but not the obligation. So you're allowed to buy the property anytime during this 10-year window. It's an option. You're not obligated to. After the 10 years, if the deal isn't good for you, you don't want to buy it, you can just walk away and the contract expires. But anytime during this 10-year window, you can buy the property. Now, if you get to 2025 and the market value of the property is 2 million, I would say buy it, because you're going to buy it at the agreed price that you set in 2015. And this is where the power of the lease option is. Not only are you getting the monthly cash flow without buying the property, you can also enjoy a flip at the end of the property value. So you buy it in 2025 for the agreed price in 2015 of R1 billion. You then go to market, sell it for 2 million rand. You make a million rand profit off flipping the property. Plus, you've enjoyed the cash flow for the last 10 years. This is an incredibly powerful strategy. Again, something that is advanced. I wouldn't recommend starting with this deal, but knowing that these options are out there, I'm hoping primes you to think that you don't need that much money to get into property. You actually just need the knowledge and the education. So this is and this is the key concept of the lease option is you never own the property. All you do is you're owning the cash flow. You're taking control of the property without buying it. You're servicing the debt for the current owner, so you're solving their need. Plus, you're essentially subletting the property out. So similar to the rent to rent, you're renting from the owner at their bond value, at their bond repayment value, plus you're subletting to a new tenant for higher value, thus enjoying the cash flow with the option to buy at any time during the 10-year period at the agreed price that you set out in the beginning. Very, very powerful. So this is an example of a lease option that I did in the UK. And the only reason I did a lease option in the UK is because I didn't have enough capital to buy a property there. So the lease option made the most financial sense. Now that is the inside of the property. And as you can see, it's a highly distressed house, a house that cannot be rented out in its current condition. Cha-ching. Also, it was a distressed seller. They didn't have enough money to renovate this property, yet they still had to pay the bond every single month. They've got a dead asset plus the liability every month. For them, they just want out. So they are willing to do a lease option. So this is how the financials turned out. We're getting rent of £425 per month. The monthly bond is £81. That is the fee that she has to pay every month for financing this property. So you can already see there's a massive difference between what we're renting it out for and the expenses we have. Now that's not the only expense. Of course, we also have insurance, service charge, a managing agent, and then monthly operating expense of 5%. Essentially, we're walking away with a monthly profit of £256. We don't own this property. This is not our property. This is still that lady's property. But what we do own is we own the cash flow for the next 10 years. And we've agreed a purchase price today. Well, we did this in 2015. The price that we agreed was £72,000. So after the 10-year period, if the property market is now sitting at, let's say, £100,000, we'll opt to buy the property, maybe remortgage with the bank, get all of our capital out. We've got now a free asset, or we could sell it. If the property market declines and it's now worth 50,000 rand, we step out of the contract. She continues to own the property. It becomes her asset again. We can go find the next lease option. And the return on investment is 34%, which is quite high because we only funded the renovation. The renovation cost in this deal was about 140, 150. I can't remember exactly. So that's a great way in which you can take 100,000, 150,000 rand and invest in a property overseas. Now again, advanced strategy doesn't come around very often, but if it does come around, it's a great opportunity for you to leverage a little money to make good returns. I'm going to try and play a video. I'm not exactly sure if you guys can see it or hear it, but it's just a minute video and you can see how the renovations have come through. So you can just see there's grey carpets, grey on the wall, white finishings. So again, I'm hoping you can see the video, I'm not sure, but you'll see all the grey carpets, grey walls, white finishings. It looks really modern, looks clean, looks professional, especially if you think back to the photos. I'm sure the quality of the video is not so great, guys, so sorry about that. I will happily send you a link of this video so that you can just see what the after property looks like. Bathroom was about 15,000 rand worth of renovations. Kitchen also looks good now. Now the only reason that I share this video with you is just to show you that's where our money went to. We don't own the property, we didn't buy it, we don't need to. All we needed to do was to take control of this dead asset, renovate it, fix it, put it back into the market. We cover her expense and her bond every month. We get the rent. We win. So a great way for you to use little money to start accessing cash flow. Now, I know this might be a little bit overwhelming, but what we are going to do is we're going to put a whole bunch of tutorials, all the webinars that we have done to date, how to analyze a student deal in 30 minutes or less, how to access other people's money, how to run the numbers, all of that stuff will be put onto the My Property app portal under video tutorials, and then also under the SAPN membership portal. And I'm just going to ask Dave one more time, and I'm sure he's already done it. Under the Offers tab, you can follow the links to find My Property app as well as SAPN. We're going to put all of the educational content there so that you can upskill yourself in your own time and in the convenience of your own home. And that, ladies and gentlemen, is my story, and I'm sticking to it. What I'm going to do now is just open the floor up for questions, and I'm also just going to ask Dave to join me in answering any questions that might come up. Okay, Dave, we have a question.
A lot. So I'm going to start from the bottom. Alfonso is asking, how do you raise development funds in the millions if you don't have an owner's contribution? I believe that's my field, right? I might be the expert there. So look, if you're looking at a smaller development company, smaller development project, under 10 million or so, then it really is a matter of the deal standing on its own 2 feet. We raise finance on deals based off of their ability to sell and be good deals, not based off of your affordability or the amount of money you've put in. So regardless of whether the seller's involved or not, it doesn't make a difference as long as it's a good deal. When you start talking north of 50 million, that's really when you need a development partner to come on board who can give you the experience and be there and handle everything. That's sort of the crux of that question. Next question is going to be, how do you raise impact funds? Also by Alfonso. Lawrence, do you know what impact funds are?
I have no idea what an impact fund is. Do you want to maybe
Alfonso, yeah, give us some more detail. You've clearly picked up a term off a podcast or somewhere that doesn't make any sense to us. Paul's asking, how do you find a good deal when I have some finance? Okay, Lawrence, you can handle that one. So Paul's got some money. He's looking for deals.
Fantastic, guys. So here's an opportunity for an angel investment opportunity. So if there's anybody that has a deal on the table that's a good deal currently, guys, please contact Paul, because that's the way in which you can do a partnership using other people's money. Paul has basically just said he's got money on the table and he would like to do a deal. So please go and contact Paul privately, but please also respect his time. Make sure that you've got a good deal. Don't just go to him and say, hey, I want your money. Explain to him where the deal or where the money is going to be spent. Cool. Next one.
Yeah. I guess my contribution to that one is also, Paul, make sure you're spending time with guys like myself and Lawrence. Not necessarily that we're going to bring you deals, but we also have people bringing us deals fairly often, which we can always pass on to you. Candace is asking, what's a good interest rate to offer investors on their money? Lawrence, you can have that one.
Yeah, cool. I think it depends the strategy, right? So if you're looking at a flip, you're looking at doing a deal over 6 to 12 months. I think a common or a good interest rate would be between 12 and 15%. If you're looking at a longer term arrangement, if you're looking to go into a partnership with an investor over a 5, 10, 15-year process, first of all, I wouldn't recommend that unless you are very close with this investor, because you don't want to get into bed with somebody that you don't have that trust or that intimacy with. But then you're looking at a lower interest rate. You might be looking at between 10 and 12%, something that's competitive with home loan interest rates. So for flips, short-term deals, I would say between 12 and 15%. If you're looking at a longer-term deal, I would say 10 to 12%. I don't know, Dave, do you have a differing opinion?
I agree with that. I've seen higher. I've seen up to 20. Definitely. It comes down to a function of risk at the end of the day. If it's an easy deal, that's a fairly low risk deal, then even if it is a shorter or long-term deal, then the low interest rate might be more acceptable. So it comes down to what the investor considers the most important thing, right? And Paul, this answers your question, which is the next question as well. It's what's the most important metric? Is it speed or is it risk? A lot of investors are worried more about the time of the deal and how long the deal is going to take and how long that their money's tied up for than they are about risk. So it's going to vary from investor to investor at the end of the day, and be conscious of every investor's got their own thing, and it really is a matter of sitting down with your investors and talking to them and understanding what they're looking for and negotiating your terms. There's no standard at all. Lawrence Faith wants to use my property app on Apple iOS.
Okay, on your Apple device.
Yes.
Okay, so currently it's still a web app, and the reason why we're keeping it a web app for now is just to, iron out the kinks. To turn it into a mobile app is a very expensive experience, so we want to make sure that we get enough feedback from a desktop or web app point of view, so that when we do implement the mobile version, it'll be ready for use. So sort of the timeline that we are looking at is that by the end of this year, we will have a mobile app for both Android and iOS. Currently, it is a web app for now.
Sherwin's looking at how do you find your deals. I find it hard to locate properties for that price with that many rooms. Lawrence, I think didn't we do a webinar on that? I'm sure we've done a webinar on finding deals.
I'm pretty sure we have found one. Sherwin, I think it depends. If you're looking in Joburg specifically, you can find a 5-bedroom house for 700,000 Rand in Brixton, or a 5-bedroom house for 1.8 million Rand in Westdean. You're obviously targeting two different types of people. In Brixton, it's lower income people where you can rent out a room for 2,600, 2,700 per month, where in Westdean you can rent for between 3,500 and 4,000. So it's a very broad question. I would recommend go and check out our other webinars regarding more, what areas are good to invest in, how to find these distressed deals.
Cool. Zukon is wondering, what are the requirements for private investors? What exactly do they look at when presented with a deal? Lawrence, what is my property app as a default in the investor proposal?
That's a good question. So essentially what the investor's looking for and what we implemented into the My Property app is that, one, they want to understand some of the basics of the deal. So where is it, how many beds, how many baths, some of the features. They'd like to get an understanding of who you are as an investor, so maybe a personal introduction as to what qualifies you to be an investor. They want to understand what the exit strategy is. So if you're looking at flipping a property, what if you can't flip it in 6 months? What is the exit on that deal? And then, of course, the financials. I guess that's probably the most important. They want to understand, if they're going to loan you R1 million, where's that R1 million going to go? How are you going to structure the deal? What's the cash flow? What's the profit? What's the return on investment? So all of that information is captured in what we call the investor proposal on the My Property app. It's a between 6 and 10-page document that covers all these aspects and all the questions that usually an investor asks when analyzing an investment opportunity. Anything I missed there, Dave?
No, I think for me, part of it is really about showing investors where you make your money as well. It sounds counterintuitive, but investors want to see that you're making a profit out of this, because any profit that you're entitled to is where their safety comes from. If you're saying, I'm going to do this deal and you're the only one making money out of it, investors get a little wigged up because they don't see that you can protect their risk. So that's always something to be conscious of.
Yeah, good point.
I guess maybe on that, another question I get a lot is, how much information do you give your investors? There's two schools of thought here. If you give them all the information of the address, the property, the owner's details, they could circumnavigate you and try to do the deal themselves. The argument that most people give is that they can only do that once and then they'll never find a deal ever again from you. So that's one way to do it. The other way is to slightly hide some information. Don't tell them the exact address of the property, but give them the street or the suburb. And then you can always give them all the information once they've signed a non-disclosure and non-circumvention agreement. It comes down to your risk appetite at the end of the day as well, and how much you trust the investor. I would send Lawrence all the information because we're good friends. I would not send all the information to a random stranger who found me on the internet. So it's always use some common sense on that as well. Lawrence, this is for you from Sherwin. When using an equity release, would my interest rate on my loan change or would it remain the same?
Very good question, Sherwin, and most likely it will change. Essentially, the bank is taking more risk because they're loaning you money. So they'll probably come and reevaluate your property to ensure that, yes, it is worth the $1 million that you say it's worth. And then they'll check your affordability, they'll check your risk profile, and they'll essentially issue you a new loan with new terms. So very common that once you ask for an equity release, or as the banks call it, a further advance, very likely that your interest rate will change. Yeah.
Cabo was asking, you're saying that your primary residence is already paid off. Can you use it as collateral to secure a deal or an investor? Lawrence, I believe the short answer is yes, but you got to manage your risk and who owns it.
Yeah, and again, it's like you're basically applying for a loan. So the bank's going to come, see the property value, look at you as an individual, check your salary, your affordability, your risk profile, and then offer you a loan on that property using that property as collateral. So yes, definitely possible. But then you got to look at the terms of that loan. So you'll probably get the loan at 10%, and you'll have to factor that into your deal to make sure that it still makes financial sense. But yes, paid off property is definitely usable as collateral.
Paul's asking, with rent-to-rent deals, do you have to get the owner's approval? Yes.
Sure. So that question comes a lot, and I think the short answer is yes. I mean, in some cases, I think the owner just wants to get that rent in every month. They don't really always ask that question, but I think for most owners, they do want to know that you're subletting. Dave, you've also had some experience in rent to rent. What's your opinion there?
Yeah, look, so as a default, some people think rent to rent's illegal because the standard contract terms for a lease says no subletting is permitted. That's pure contract law, and you can just cross that out of the lease agreement, and then you have permission and the right to sublet. I guess it's answers to Bisa's question, which is coming up just now as well. It's yes, landlords are willing to sublet their properties as long as you're providing the appropriate incentives. It's not what you want; it's what you negotiate. That's what's key. So often what I'm doing with rent to rents is I'm offering to cover rates, taxes, levies. I'm offering to take over the homeowner's insurance, that sort of thing, to incentivize the property owner to give me the deal. So I'm going to make their life easier, and that's when they're going to start working with me.
Good point.
Eric wants to know what the exit strategy would be for rent to rent. Eric, it's a lease. You cancel it. Simple as that. You could always look to under rent, but it doesn't make sense to do a rent to rent if you're not going to make money. So there's the only exit is to get out of the property. Tarai was asking about an installment sale. I guess that was probably a pretty specific question based off of the slide. So Tarai, you would have found that Lawrence refers to Alienation of Land Act as the act which allows us to do ISAs. Either way, call it an ALIA, call it an ISA deal. They're all the same thing. Installment sale agreement is the mechanism that we use legally to do those deals. Lawrence from Leon, he wants to know, with a lease option, would you be paying rates and taxes?
Yeah. So you pay everything as if you were the landlord or as if you were the owner of the property. So rates and taxes, levies, bond, basically you control everything that happens on that property on a month-to-month basis. You just don't own it. So you got to make sure, obviously, that the rent can cover not only the bond, but also all the expenses related to that property, plus then some, so that you've got the cash flow at the end of the day.
Marlon wants to know where he finds distressed sellers.
I think it's best to go and check out that webinar that we've done on finding distressed deals. Again, at the members portal on Sapin or My Property app, we've done I think quite a lengthy webinar on how to find distressed sellers and distressed properties.
Yeah. A finance code.
Sorry, Dave, I lost you there.
A car, can they use it with the banks or with an investor?
Sorry, you broke up there again. Can they use their car as collateral?
Okay.
Is that the question?
Yes.
Yeah, anything that is an asset that can be used as collateral, such as a car, a ring. I mean, I guess you could go to the banks and say, I want to loan 10,000, and if I can't pay the 10,000 off, then here's my wife's ring or my husband's ring or whatever it may be. So anything that the bank would look at and say it is worth this amount of value, if we had to, repossess it in order to pay back your loan, can be used as collateral. Even a life policy or an insurance policy or pension fund, you can loan against that, value as well.
Yeah. Special RA, that's pretty much the only line you can't cross. Hello, is it better to look for a bank bond or an angel investor? And is there a limit to how many bank bonds you can have? I have 2 properties at the moment, and I find it difficult to get a third bond.
Yeah, good question. I think you might have gotten stuck in the trap of buying negative cash flowing properties, which means you have to fund the property every month because the bond is higher than the rent, and then your affordability goes down. So the banks will look at a deal and say, or will look at you as an individual and say, you're earning 30,000, but you're spending 30,000. So if we have to give you a loan, you've got no extra additional income to pay off that loan. So therefore, you've reached your cap. Your affordability is zero, so you can't loan a deal. If you're buying cash flow positive properties where you're making a profit every month, that profit can be added to your affordability, which means you won't run out of money with the banks. The first question, who to choose between banks and investors, you got to look at the deal. Will the investor give you better terms, or will the bank give you better terms? Usually investors enjoy or are willing to take a higher risk. So, sometimes you'll ask the bank for money, but they won't be willing to take the risk in your deal. Maybe a private investor will. So I think it's more on a deal-to-deal basis. What can your deal absorb from a financial point of view, and which one of the two avenues, being investor financing or bank financing, provides you with the best terms? Dave, do you want to add to that?
No, that was pretty succinct. At the end of the day, if you can't get bank finance, then that's pretty much your limits. Your personal surety is going to be managed by that. You can look at when you restructure and when you move your structures around, you can look at being a little more smart and more careful with the amount of debt exposure you have. But if you're currently near your maximum lendability, which is, I can't remember what the metric was, I think it's 40% of your disposable income, then you're at your limits. The only way to get more bank finance then would be to make more money. And that's pretty easy to do if you're doing rent to rent. So that's why we often look at rent to rent strategies and back to backs, because you don't need to necessarily use your affordability to do deals. Next question from Matilda is when you access equity from your home loan, does the home loan increase in payments to the MOE of the investment? I don't know what that last part is, but yes, Matilda, it is likely that you will have an adjustment in your payment and maybe even your interest rate when you access finance. Gerald is asking, how much risk should a first-time property investor take? Just an estimate. Lawrence?
Well, it depends how you quantify risk, I think. So it's a difficult one to answer. I think if you're a young guy starting out, you probably have a higher risk appetite because you've got more time to work back versus somebody who's maybe a little bit older and has kids and has more responsibilities. I think sure. My favorite question when a student comes to me with a question around risk is, if you had to lose all the money in this deal, could you recover? That's sort of the worst case scenario is if you do a flip and you're going to lose money on this deal, if you're going to lose 200,000 Rand and you're willing to accept that if that's the worst case, I can recover, then you're able to take that risk. I think sometimes as investors, we get seduced and excited by the returns that we forget to look at the possibility of losing money, which is a very real and often probability with property investing. So as much as, yes, you need to look for the returns and how this deal will succeed, look at how it will fail and ask yourself, can I absorb this risk if things go bad? I think that's pretty much what I would say. Dave?
Yeah, no, I agree with that. At the end of the day, risk is always going to be a factor, and how much risk you can take, it's going to vary. It's like Lauren says, I'm more risk inclined. I don't have a wife and a kids. Maybe you do, and that's going to make you less risk adverse. And then again, maybe you're more risk adverse because you're stuck and you really need something to change. So it really is just an internal conversation you need to have. And if you do need some advice, you're going to need to get a financial advisor to help you understand your situation. Tarai is asking about protecting the information of the property for the investors so they don't go behind your back. Tarai, I think we did answer that. Ideally, trust is one, because that's the quickest way to do it. And then if they screw you over, then they can only do it once, and then they'll be forever black marked in the network and in the community. The other way to do it is with legal contract law, and then you'll need a non-disclosure and a non-circumvention agreement, which is some pretty boilerplate stuff that Bruno could give you. Lawrence, do you have any input on that one?
No, I think you've nailed it there.
Theo wants to know, would the bank release equity on a property that is to be developed? Theo, no. If it's still going to be developed, then there is no tangible equity or value in the property until the development is complete. That's would be my understanding of it. You generally, if you're looking to get a development loan, that's a slightly different thing. Yeah, that's the way I understand that question. Unless Lawrence, you have another thought on that.
No, I agree.
Is it advisable to have the investor fund the full amount of cash flow into the deal, and how would the repayment terms look likely compared to a traditional home loan? That's a good question, Lawrence.
Yeah, I think you've got sort of approaches here. You can essentially pay the investor back like you would a home loan. So you pay the interest amount and the capital amount every month until the home loan or the loan is paid over the agreed time period. You can also agree an interest-only payment, which means every month you pay the interest amount to the investor until the end of the payment or until the end of the term, and then make the full capital amount at the end. Or your final sort of opportunity is to pay nothing during the term, so paying nothing on a month-to-month basis, but at the end of the term, let's say you loan the money for 2 years. At the end of the 2 years, you pay capital and interest all in one go. So those, you've got variations of those different three modules, but essentially you're either going to pay interest and capital every month, only interest every month, or no interest, no capital every month until the end of the term, and you pay the full amount in one go.
I think my other thing to add to that is bear in mind that there's a point where you could also get an investor on board to get a home loan. A lot of investors who start out, they don't have affordability, they're not lendable to the banks, and you can always syndicate with someone who can get a home loan and partner with them on a deal. Then you get a bit of a best of both worlds situation, which is quite fun. Tutuka, what's the exit strategy on multi-let deal? Well, Lawrence, you can handle that one.
Exit on a multi-let, yeah, good question. If you've got a multi-let and it's a house, your exit is to renovate it or bring it back to the house's condition and then sell it to a family. You're obviously going to lose money then. But if you buy like a block of flats, like the example that I showed Centurion Court, where there were 4 separate 3-bedroom houses, what you can do is you can sectionalize that block of flats from 1 block to 4 individual units, and then sell each unit as a standalone house to the market. So that's the exit strategy that we have with Centurion Court. We bought it for 1.5 million. But we can sectionalize, which costs about 30,000 per property. But then we can sell each one of those individual flats for about 450 to 500,000 rand. So we can quite easily recover our initial cost plus make profit if we want to sell for some reason. That would be the exit if you buy a block of flats as opposed to a house that's been turned into a multi-let. A house turned into a multi-let doesn't have a clear exit.
Yeah, look, at the end of the day, your exit is always going to be determined by the market. That's sort of the short answer as well. It's you might want to do student accommodation, but if the property is nowhere near student accommodation, then you can't necessarily do that. You might be aiming for student accommodation, and then you might think that professional tenants are a good exit or families are a good exit, but they might not be. So you really need to understand the situation of the property and what the property can do. Most people wouldn't be in a situation where you could look at sectionalizing out a unit and selling it. Because most multi-let properties are single residential properties. So it really is something you've got to understand the market. You've got to understand the options that are available to you. Let's just go through a few more. Lawrence, if you need to go, you can take off.
Yeah, that's okay. I've got another few minutes.
Another few minutes, good. What vehicles do you buy in properties? Same thing to rent. Lawrence, I want to answer this one if you don't mind. To Rai, it doesn't freaking matter. Do a deal. First deal, just get it done. Doesn't make the biggest difference. You'll pay some tax either way. As long as you're doing your first deal and it's done, that's the most important thing. Don't get stuck on structures and that sort of thing. Just get the deal done. But in short, but the other side of the answer, to give you an actual answer, is I have companies which are owned by my trust, single trust, and that's pretty much it. I don't own anything. I don't own my companies. I'm a director of my companies, and those trusts control it. Same with rent to rent. I just separate the different strategies into different limited companies that are all owned by the same trusts. Lawrence, I'm assuming you agree with that?
Yeah, all on board.
I want to buy a flat for rental, but my bank won't finance. If I use an angel, what should my repayment terms be like? Because I will not be selling on the property in the next 24 months. Lawrence, do you want to handle that one?
Yeah, Desiree, it's very hard to answer these questions because we don't know what the numbers look like. So it's very hard to say that you need to have a 12% interest rate with your investor if we don't know what the deal looks like. So remember, principle number one is find and analyze a good investment opportunity. If it's going to make money, then you can approach an investor and begin the negotiation in terms of what do they want out of it, what interest rate will they accept. I think the biggest mistake that most people make is they look for the money first and they go to an investor who's got money and says, I'd like your money. And then the investor will say, okay, what are you going to invest it in? And if you don't have an answer, you put a bad taste in that investor's mouth. So my advice is principle number one, find and analyze a good deal, make sure the returns are good, then approach an investor and begin the negotiations as to what terms would be applicable.
Yeah, I think to add to that, bearing in mind, I have a very strong rule that I don't have long-term relationships with investors. I know Lawrence, you're in a one long-term loan, and that's admirable from my perspective. I wouldn't do that. I would say that if you're really looking to build a rental portfolio with finance from investors, I would advise you to rather look at building your capital and building your passive income through other means first so that you could afford your own bond for your own rental portfolio. Or have a very clear path to get that investor out of the deal, where maybe you're limited to your affordability, get the property, get the angel investors loan in place, show the banks 6 months, 12 months worth of bank statements and good income, and then your affordability can go up, and then you can buy the investor out with a bank loan. Bearing in mind you'll have finance costs to deal with, and obviously the interest from the investor. Good evening. Does it make sense to balance a property portfolio with a few break-even properties that'll grow in capital value, or is it individual cash or risk dependent? Interesting question. Lawrence, do you have some thoughts on that one?
Yeah, I think whenever I hear the idea of capital value and increasing capital value, the first thing that comes to my mind is speculation. As much as you can, with relative accuracy, say an area is a good area and will appreciate in value, you're still speculating and trying to time the market, which is always a risk. So for me, and this is my personal investment philosophy, is cash flow is king. If you've got cash flow in the deal and you're making profit on a monthly basis, whether the market goes up or down, you're not going to be enticed or scared to sell. And property is a long-term game. So you want to have a good cash flow to hold the property for 10, 15 years, to go through the depressions and the recessions, because property has got an inevitable curve upward. I think my advice would be you can maybe get some break-even properties in there so that you can maybe reduce your tax liability, but don't do it for capital appreciation. Always focus on the cash flow first. Let the appreciation be an added bonus to your portfolio. But that, like I said, that's just my personal philosophy. I don't think there's a right or wrong to your approach.
Yeah. Look, I think the other side of that is bear in mind that you should analyze your portfolio every year and readjust and sell properties based off of the return of your equity. How hard is your money that's in that property working for you? Because that's the compound effect, right? That's where we can get compound growth on our monies, because we move our money to better deals all the time. So bear that in mind. I've bought a few properties in Midvale, east of Joburg, and I need investors to complete renovations. Is anyone who can help me? Truly, at the end of the day, you need to put together investors' proposals, and you need to share that investor proposal through the network. My suggestion is the next event is in Centurion on the 20th of May, I think. Come to the event, show us your deal at an event so you can actually talk to people face to face and start building relationships with investors. To Rise asking, how big are our support or implementation teams?
You're currently speaking to them.
Yeah, look, I've never had full-time staff in place to manage my property investing business because of how often I change strategies and grow. At my peak, I was hiring 7 part-time staff members, and I've got 1 admin assistant who works sort of 2-3 days a week at the moment managing the deal funnels for me. So, yeah, most of my support and implementation teams are subcontracted in their attorneys, those sort of people. And then that's a very long list of people, I guess.
I think back to your first point, Dave, is just first do your first deal, and once you've done a successful deal and you start doing multiple deals in a year, you can look at support and implementation teams. But right now, the crux is get the first deal across the line. That should be everybody's focus on this call. Is not how can I do back to backs and lease options and 20 deals a year. How can I complete one successful transaction and get some confidence moving forward? I think that should be the focus.
Yeah, that's a good answer. Sean is asking, why are you put my different strategies into different companies? Sean, it's a pure risk mitigation strategy. If something goes horribly wrong in a deal, then if I had all my properties in a single company, then all those assets are liable for lawsuit. But if they're in separate boxes and separate little spaces, then there's no way that they legally can go up a chain and down a chain to hold my other companies liable for something that I did in company A. And this doesn't mean I'm trading negligently, but maybe one of my buildings collapses or burns down and I'm held liable for damages. It's not a situation I want to deal with, but it's a situation I want to plan for. It also it keeps my tax in a slightly better situation because I have my holding assets in a limited company, which is separate to the business that I do flips or referrals in. So that way, when I declare my taxes to SARS, I can say, SARS, this is where I do rental income and this is where I do capital flip income, and then I can have it all treated differently. Which sort of gets us onto Tuli's question of how much tax are you liable for an informal rental business? I don't know what an informal rental business is.
I would assume it's still the same at 28% that every company is taxed. But I think this is where maybe leveraging an accountant specialist and paying an hour consultation time with them to understand your exact implications is what you need to do, Tuli.
Yeah, 100%. But the short answer to that is you pay 28% of all your income after expenses. Bearing in mind that your loan capital repayment portion is not an expense, it is a loan repayment. So I suggest A, chatting to an accountant, and B, getting yourself a spreadsheet that can help you understand the difference between taxable expenses and non-taxable expenses. To Rai, what legal implications on deals such as rent-to-rents when you have a lawsuit? Depends on what goes wrong, to Rai. Ideally, nothing. But the thing that I'd be most concerned about, given the conversations that I'm having at the moment with people, is if you look at a multi-tenant situation, multi-tenant properties operate in a bit of a strange space legally where there's not a lot of law around that. Joburg's got a bit of a commune status thing, but it really is a bit of a density thing. So really make sure you're covered from a fire safety perspective and you should be fine. Make sure you have the correct legal disclaimers and make sure you have good insurance and you should be fine from lawsuits. For overdraft finance, how do you repay the institution? Do the bank take the whole owed money? Niza, I'm not quite sure what that question means. Tuli, how do you find an accountant? Very simple. You go to the SA Property Investors Network and you check out our Power Team section and you'll find a link to Kettle Consulting. At the end of the day, most of your network is going to come from people who you know and asking them for referrals and that sort of thing. Lawrence, who are you using at the moment?
I'm using a guy by the name of Michael Mervitz. I'm just going to pop his number onto the chat. He has been very useful for me. He's based in Pretoria, knows the property game pretty well. You are welcome to give him a call. His name is Michael. And you can just say that I referred you, and hopefully he will give you some sort of discount. But I think to David's point is we understand property investments. That's our specialization. When we're talking legal, tax, any other refurb, we need to pay specialists in that field to give us the right advice. So I think it's very wise to go and check out the members portal and go check the Power Team members that we recommend, and then go and pay them for their professional advice, because you are going to be investing a lot of money into deals. You'd rather pay a little bit upfront to make sure you're doing the right deal than to try and save some costs and end up shooting yourself in the foot later on.
Cool. I think this will be the last question we take. It is starting to near a bit late. Tweety's asking, is it wise to put a deceased estate property while the matter is still in process? Okay, that's probably a bad last question to choose. Tweety, I'm not quite sure what you're asking. At the end of the day, you could try and put an offer to the estate while the estate is being wrapped up. That is fairly common. It can be a challenging buying process because of all the parties involved. I think so. Cool. Lawrence, I think that's the last question, unless you want to take do you want one more question?
Yeah, I mean, I'm happy to take Maz. Listen, yeah, whenever you can access financing, you can do a property deal. So 17 and age is just merely a number. You can do a rent to rent today. You can do a deal today as long as you can access the financing. So I don't think there's a specific age in which you can or can't do it.
There's always ways around it as well. I think you can't own property as a minor, which is under 16, but you can technically own a company, and you might need an adult to operate that company and trade as the director, because you'd be a minor. But there's always ways around it as well. It might require some trust and the right structuring, but there's going to be a way around that that's an age issue if there is one. Lawrence, I think we're done there. Thank you very much.
100%. Thank you, everyone. And until next time, happy investing.